So this is an extremely important video. I want you to pay very close attention here because I want to share two statements with you here. And these are extremely important concepts for you to understand. Both of these statements are diametrically opposite statements, but both are correct as far as stock market is concerned. So let us first look at the statements, who said what, and let us try to deconstruct what they're trying to tell us about the stock market. So both of you, sorry, I assume that you know both of these people. One is Mark Minervini, who is a two-time US investing champion. Warren Buffett, everybody knows, is the richest man in the world, chairman of Berkshire Hathaway. So Warren Buffett is a value stock investor. Mark Minervini is a growth stock trader. So let's first try to understand why I have mentioned these designations here. So Mark Minervini is someone who is a trader. Okay, most of his career he has been trading, not investing. Trading means your time horizon is small. Maybe you will hold the stock for 1 or 2 weeks if it's a swing trade, or if it's a positional trade, you might hold it for 6 months, 12 months, probably more than that. Okay, and even during that time, you might scale in or scale out of position. That is called as trading. Investor means you probably have a minimum time horizon of 5 years, maybe 10, 20, 30, 40 years. Warren Buffett has not sold Coca-Cola stock, Washington Post, American Express for 3, 4 decades. So that's the definition of an investor. You buy a stock, you look at the business behind the stock, and then you decide to take a position without any intention of selling the stock ever, because you own a piece of a business. That is how you perceive that business. You are looking at the business behind the stock. You are not looking at the stock itself. Whereas, as far as trading is concerned, the goal is to make a quick double digit gain in 1 or 2 weeks and then keep compounding those gains while you are controlling risk, not allowing your loss to go beyond an average of 5 to 6%. But when your stocks go up, try to capture double digit return, preferably more than 20% over 2 or 3 weeks if you buy at the right point. So I hope you now understand the proper difference between investor and trader. Now let's come to growth stock versus value stock. Growth stock is a stock which is currently showing explosive growth in sales or earnings, or sometimes a stock might not have any earnings at all, but because the nature of the business is such that, let's say, biotech company, they are in the process of inventing some drug or whatever, they are coming up with something which could get patented. Okay, and they could have some advantage in the future because of that patent. So that could drive up a stock price. Or maybe there is a company which is currently making losses, but gradually the losses are declining. So even if it's making a loss, the market is thinking that probably in the future the stock might go up rapidly, because once the company becomes profitable, a lot of value investors might come into the stock. So sometimes a growth stock may not have any earnings or any fundamentals at all, but it is still a growth stock because it is showing strength in price. Majority of the growth stocks show explosive quarterly growth in earnings and sales. Okay, so that is a growth stock. So you wouldn't mind paying a PE multiple of 100 or 200 or even 300 while buying that stock, because it is showing extraordinary strength and it is coming out of a base. Mark Minervini is not someone who will look at the PE ratio. He might look at the PE ratio of the stock now versus 5 years ago, but while buying the stock, he is not looking at the PE ratio. At least he is not paying much attention to the PE ratio, because he knows that he's getting involved in a growth stock which is showing some strength because of some other factors apart from earnings and sales. Value stock is a stock where you are not looking at the stock itself, you are looking at the business behind the stock. You are comparing the market value of the company to the pre-tax earnings of the stock. what is the stock earning on a pre-tax basis? Because all the investments in the world are looked at from a pre-tax basis. How much return are you going to get? So, for example, if you make a fixed deposit in India, they might tell you that, okay, we will give you a 7.25% return, but that 7.25 is pre-tax. So all investments in the world are looked at on a pre-tax basis based on what they can yield. So similarly, when I buy a stock, I want to see how much is it earning on a pre-tax basis. So that pre-tax earnings divide by the market value, which the value that I pay, the price that I pay to buy the stock, that pre-tax earnings divided by the market capitalization of the stock, that yield is called as the yield or the interest equivalent to an interest that I get on an FD. So that's the number I'm looking for. Okay. So that's value stock investing. So let's say I buy a stock for $100 per share and the pre-tax earnings is $2 per share. So I'm getting a yield of 2%. That's a pre-tax earnings yield. However, if I'm getting some other stock with a earnings yield of 10%, that stock is probably better valued than the 2% stock, provided both are showing consistent growth, consistent earnings, strong fundamentals, etc., etc. So the valuation of a stock is a very subjective concept. Just because the yield on a stock is small doesn't mean that the stock is bad. Maybe it is expensive. The stock is expensive, and just because the yield of a stock is very high doesn't mean that the stock is cheap. Okay, there could be a problem with the company because of which the market value has gone down. Okay, and people are not willing to buy the stock. So with value investing, you really have to investigate. This is where you have to do investigative detective work. Here you have to look at the earnings growth, sales growth, return on equity, and the chart, technicals and fundamentals. That's it. We don't go beyond that. But with value investing, you really have to dig deeper, because as a value investor, you are putting like minimum 10%, 15% position in a stock. Whereas as a trader, you might start with 5%, 10%, then gradually add to the position as the stock starts to give you more returns. So let's say what they have wrote or they have said in one of their interviews. So Warren Buffett says in the stock market, you don't get paid for activity, you get paid for being right. So what Warren Buffett is saying is that if you keep buying and selling stocks, you are trying to benefit your broker. Okay, your broker is making money as long as you are buying and selling stocks, because he is earning commissions. Okay, so you don't get paid for doing activity, you get paid for taking the right decision, even if it is one or two decisions in a year. As long as those are right decisions, as long as you are getting into the right business at the right price, you are doing well as a value stock investor. Now let's look at this statement. Mark Minervini says, I generally make between 150 to 250 trades per year. This is like 2 to 4 trades per week. Okay. 150 to 250 trades per year, depending on the health of the market. Many of those trades are due to quick loss cutting, which increases turnover. So here we are looking at a two-time investing champion who is taking like more than 200 trades in a year. So this is like activity. And Warren Buffett is saying you don't get paid for activity. So what is happening here? So as Mark Minervini says, many of those trades, so I'm assuming that 60% of his trades, because he has mentioned in one of his interviews that his batting average, his accuracy is 40 to 50%. So we can safely assume that 50 to 60% of the trades that he has taken have gone against him. Okay, so he has been very quick in cutting the loss. He is not allowing the stock to hit his stop loss of 8% or 10%. He will quickly cut the loss at maybe 2 or 3% and then move on to other stocks. But the remaining 40% of the stocks that have actually made him money, there his average gain is far bigger than on a winning trade compared to the average loss on his losing trade. Okay, that's where the reward to risk ratio comes in, and that is why he's able to deliver like triple digit returns per year, and he's taking large positions like 15, 20, 25% position depending on the stock, whether it is fundamentally correct, whether it is technically correct. He will look at multiple factors and then he will decide how much position size he wants to go in with. So these are two diametrically opposite statement. One is a two-time US investing champion who is putting like 250 trades in a year. One is a value stock investor. Okay, he will buy just one or two stocks in the entire year. It's like just taking one or two decisions per year. But behind those two decisions, there is a lot of research and study. Here you are buying 250 trades. You are taking 250 trades. So you don't have time to read 250 balance sheets, right? So you can see how the approach is different. The approach is totally different, but one is a millionaire, one is a billionaire. Both are successful. So why is it that these two are diametrically opposite statements, but both are successful? Okay. The reason is, the common factor is, and here is an important thing, both of them know what they are doing. Both of them know what they are getting into. So when Warren Buffett is buying a stock, he is buying with the intention of never selling the stock. It's like he's buying a business which he expects the business to deliver him the returns. He is not looking at the stock market. So he knows exactly what he's doing. He's not buying a stock. In his mind, he's buying a business and he's looking at the earnings of the business to give him the return in terms of principal and additional yield on top of the principal amount that he has invested. So he's not expecting capital gains. He wants to hold on to the stock forever. So he's thinking multi-generational, like he wants to add companies to his portfolio of companies. And Mark Minervini, he knows exactly what he's doing. He wants to get into a stock, look for a double-digit return in 1 or 2 weeks, maybe 3 or 4 weeks, and maybe sell up a part of the position, move the stop loss to break even, and free roll the trade as long as it remains above the 50-day simple moving average. So both of them, although their view about the stock market is diametrically opposite, okay, one likes to have turnover in the portfolio, one does not like to have turnover in the portfolio, and both of them really believe what they are saying. I mean, Mark Minervini has actually mentioned about turnover in his second book, Think and Trade Like a Champion, where the subtopic is turnover is not taboo, where Mark Minervini actually believes in his mind that turnover is not a bad thing. And Warren Buffett actually believes in his mind that turnover is a bad thing. You should not have turnover in the portfolio. So we are not just talking about statements here. They actually believe that turnover is good or turnover is bad. So we are really talking about the beliefs of the two greatest men in the stock market who have been very successful. Diametrically opposite beliefs, but both are successful because of one common reason. They know exactly what they are doing. Okay, they know exactly how much risk they are taking. They know exactly what to expect from their investment. So you should know, before even you take a position in the stock, you must know what criteria you are looking for before you put any money at stake. You should have a proper entry strategy. You should have a proper exit strategy. You should have your time horizon in place. You should have your position sizing and risk management in place. If you don't know all of these factors before you buy a stock, you are not on the right track. So please learn from both of them. I'm not saying that one is right and another is wrong. I'm not saying as one is a millionaire and another is a billionaire, so the billionaire is right. No, that is not what I'm saying. Okay, because it doesn't matter whether you are a millionaire or billionaire, as long as you know what you are doing and you are successful. The point of this video is, before you take an entry into the stock, you should know exactly what you are getting into. Your entry and exit strategy should be predefined. Okay, so I hope this video was helpful. I took the time to spend on this one single slide to explain to you the importance of having a plan before entering the market. So please, if you like my content, please like, comment, and share this video so that this video reaches people who really want to become professional stock traders. Thank you so much.